We have our P&L sheet. And now we've also added a cash flow calculation sheet. Here, we've created a structure that allows us to calculate the actual cash flows of the project. I will be happy to walk you through this structure. We start from savings, which is an approximation of operating income in our model. Then we subtract the taxes the company pays every year when its earnings before taxes result is positive. We calculated these figures in our previous lesson, remember? Good. Delta working capital is extra working capital we'll have to invest when moving the plant from Italy to Vietnam and to adapt to the changing supplier and inventory time conditions. That's something we've already calculated in the working capital sheet. Then we have CapEx invested in the plant. We obtained these figures in the fixed asset roll forward sheet. The sum of these items gives us operating cash flow. Below operating cash flow, we'll consider we used debt financing. Therefore, we must show the cash impact of debt reimbursement, interest expense payments, and covenant charges. Once we have done that, we arrive at net cash flow, the actual amount of money that will go in and out of the firm's bank account. Awesome. Aren't we forgetting something? Oh, yes, 2 things. Residual value. We had to indicate that at the end of the 10-year projections period, the plant will be valued at $100 million minus outstanding debt. And what else? Oh, yes, we still haven't calculated the equity necessary for the project. We shouldn't presume the project will need equity in year 0, only because if cash flow in a year becomes negative, the company must fund such a shortcoming and continue with debt repayments. Therefore, to calculate such equity increases, we'll go to the financing sheet and start from year 0. In this row, we have linked to the company's cash flow in a year 0. And then below, we can calculate the equity for year 0, taking the opposite of the net cash flow in year 0 plus the debt at year 0, which is $200 million. Okay, this is the equity in year 0. What happens later? We'll need an if statement. If cash flow in a given year is positive, we do nothing. The company sends home the cash and that's it. However, if cash flow is negative, we must increase the equity invested in the project by the same amount as the negative cash flow to compensate for the money we've lost and repay financial liabilities. This gives us equity financing. Perfect. We are ready to continue and calculate the project's weighted average cost of capital.